Good morning, ladies and gentlemen, and welcome to the ESKEN Limited Interim Results Investor Presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Just please simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard and will notify you by email when they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we would like to submit the following poll. If you would give that your kind attention, I'm sure the company would be most grateful. And I'd now like to hand over to Lewis Gurwood, CFO, and David Shearer, Executive Chairman.
Good morning and welcome to ESKEN's interim results for the 6 months to 31 August 2021. This has been a period in which we have simplified the group, focusing on two core businesses and delivered improved financial performance. We are now well positioned for growth as markets recover. Today we plan to take you through our key takeaways, our interim results, and provide details of our renewable energy and aviation operations and the opportunities which they have. This has been a period of improved financial performance delivered on the back of a clear strategy. We have recorded a marked improvement in energy performance, with EBITDA up 279%, following a return to pre-COVID market conditions, with improved availability of wood, higher gate fees, and more reliable end customer plant performance. This business now has a more resilient base following a period of resolving teething problems as energy plants were commissioned. Aviation has also seen an improved performance, helped by strong cost management, though the key driver for that division's EBITDA performance is the receipt of one-off sums connected to Connect Airways and the conclusion of our partnership with Teesside International Airport. We continue to tightly manage our liquidity position following the company's refinancing, which included a transaction with Carlyle that both demonstrates the perceived long-term value of LSA and provides almost 20 million of ring-fenced cash to our airports and supports our plans going forward. We have also today announced a board and senior management team structure that will allow us to maintain consistency and stability. I will remain as Executive Chairman with responsibility for stakeholder management, execution of strategy, and executive leadership. Lewis Gurwood will take on the additional role as Executive Director, Aviation, with main board responsibility for that division. Nick Dilworth, COO, will take on the additional role of Executive Director, Renewable Energy, with main board responsibility for that business, along with his existing responsibility for ESG. And finally, David Blackwood will become Deputy Chairman and Senior Independent Director, providing the board and shareholders with a point of reference independent from myself. On slide 4, we set out our strategic priorities. These are now much more focused than they were in the past. We plan to grow the profitability of Stobart Renewable Energy through continual improvements in the business's operations and selectively broadening the service offering. We will develop the commercial passenger offering at LSA, where we are targeting commercial passenger flying that is profitable for all parties, and the team are in constant dialogue with a wide range of airlines. We continue to maintain tight cost control and manage liquidity, and will focus on taking advantage of efficiencies arising from the simplified group structure. This includes managing costs with Stobart Air and Proprius and our work to dispose of our £39 million portfolio of non-core assets. This element remains in line with management expectations at the time of the refinancing. It's important we provide an update on our ESG progress, particularly against the backdrop of COP26, and the company is participating in several initiatives to support the conference over the next 2 weeks. Taking a step back, ESKEN started its ESG journey in earnest in September 2019, when we appointed external consultants to carry out a materiality assessment. We developed our 5-pillar framework that we are now progressing and appointed an ESG manager in January 2021 to deliver our framework program. Our current focus is on data gathering so that we can measure accurately the progress and set appropriate reduction targets. We're also putting in place the right governance structure to place ESG accountability at the board level and then down throughout the business. I'm pleased to report that we will be in a position to report Scope 1 to 3 data and financial disclosure on climate change at the time of our full year results. We've formally organised our charity support through the appointment of official charity partners Mind Essex, Help for Heroes and FareShare. As mentioned, we have a new governance structure in place with visibility at board and audit committee level, and the executive team and divisional board representatives will be setting ESG-related KPIs later this year. I will now hand over to Lewis to discuss the financial performance for the period. Lewis.
Thank you, David. I'm going to start by looking at a summary of the financial performance. Group revenue is 51.7 million, which is a 7.7% increase on last year. The main driver is our energy division. We saw an improved performance as we see market conditions returning to pre-COVID-19 levels. EBITDA is a 5.6 million profit, an increase from a 3.8 million loss last year, with all divisions delivering an improvement on last year. We will take a look at the divisional EBITDA results in more detail on the next slide. Loss before tax of 12.5 million improved by 21.9% this year, which was driven by the 9.4 million increase in EBITDA year on year, less an increase in net finance costs. Net debt, excluding IFRS 16, is 123.4 million, which is an improvement from year end due to the 58.1 million increase in cash outweighing the increase in debt. Headroom of 90.5 million represents cash of 70.5 million and 20 million of undrawn facilities on the RCF. Moving on to slide 8, we'll take a look at the divisional performance of revenue and EBITDA. These results are for continuing operations only, so do not include Stobart Air and Proprius, which are presented in discontinued operations as a result of Stobart Air entering liquidation in June 2021. Overall revenue has increased from 48 million to 51.7 million, and EBITDA increased from 3.8 million loss to a 5.6 million profit. The aviation division has been impacted by COVID-19 travel restrictions in what continues to be a challenging environment for the industry. Passenger numbers at LSA were 46,000 compared to 124,000 last year. Revenue decreased from 13.5 million last year to 12.9 million this year. However, EBITDA improved from a 0.9 million loss to a 0.8 million profit. This reflects the performance of the global logistics operation, continued cost management and receipts associated with Connect Airways, and the conclusion of the partnership with Teesside International Airport. In the energy division, tonnes supplied increased from 0.6 million to 0.7 million as market conditions are improving as expected. Revenue increased from 33.2 million to 38.1 million, and EBITDA increased by 279.1% from 2.4 million to 9.1 million as a result of improved wood supply, gate fee pricing and plant availability. Revenue in non-strategic infrastructure decreased to a 0.3 million this year, following the reclassification of a lease from revenue to balance sheet. However, EBITDA benefited from a reduced cost base at Carlisle Lake District Airport. Group central revenue reduced due to remnant royalty income included at the beginning of FY20. EBITDA has benefited from continued cost management. Moving on to slide 9, starting with the EBITDA loss of £3.8 million from last year, we can see that all divisions have delivered increased EBITDA this year. The overall improvement to a 5.6 million profit represents a 246.6% increase. Our two core operating divisions, aviation and energy, have been the main contributors with 181.4% and 279.1% increase respectively. Moving on to slide 10. Here we can see the movement from EBITDA of 5.6 million, as seen on the previous slide, to loss for the period of 6.4 million. This has been colour-coded to allow focus on the cash and non-cash items. Excluding discontinued, the cash items total positive 0.6 million, and the non-cash items total negative 4.1 million. Depreciation is broadly in line with last year at 10.1 million. The cash finance cost of 5.1 million is interest payable on leases and debt. Non-cash items totaling 2.9 million are the release of debt issue costs of 3.9 million and foreign exchange losses of 0.6 million, partly offset by the derecognition of a 1.6 million financial liability. Continuing loss before tax is 12.5 million compared to a loss of 16.1 million last year. Tax is a 9 million credit, largely due to the release of tax provisions. Including discontinued results from Stobart Air, Proprius and Stobart Rail and Civils, the loss for the period 6.4 million, which is a 92.7% improvement from an 88.1 million loss last year. Moving on to the next slide, this chart shows the movement in cash in the period. We successfully generated net proceeds of 164.7 million from the equity raise and refinancing in August 2021. This enabled us to repay all outstanding bank debt and will allow the business to meet its ongoing working capital requirements. 2 grants were received in the period at LSA relating to the Airport and Ground Operations Support Scheme and the Port Infrastructure Fund. 70.7 million of debt, including interest, was repaid in the period, which includes the RCF and lease repayments on property and equipment. The cash purchase of tangible assets of 2.5 million was spent at LSA, which includes upgrades to reduce queue times and enhance passenger experience. After other small movements totaling 3.8 million, and before the impact of discontinued operations, the cash balance is 102 million pounds. Including cash spent in Stobart Air and Proprius and a small amount relating to Stobart Rail and Civils, the final cash balance at year-end was 70.5 million pounds. Next, we have the balance sheet, where overall net assets have increased by 43 million pounds in the period to 91.3 million. Tangible assets reduced in the period as the depreciation charge outweighs additions. Cash increased by 58.1 million as funds generated from the equity raise and refinancing outweighed the RCF that was repaid. Loans and borrowings have increased since year-end as the RCF, which was drawn at 55 million pounds at Feb 2021, was drawn at 108 million pounds by the time it was repaid using a new convertible loan. Lease liabilities decreased as 13.5 million related to Stobart Air at year-end, which has since been removed from the balance sheet when Stobart Air entered liquidation. There was also repayment of leases in the period, which is mainly the aircraft. Gearing has reduced from 519.2% to 251.9%, and gearing excluding IFRS 16 reduced from 121.4% to 93.9%. This was a result of an increase in net assets and a reduction in net debt as the increase in cash outweighed the repayment of debt in the period. Moving on to net debt movements. On this slide, we can see the movement in net debt from the year end. The most significant movement is the cash generated from the capital raise in August 2021. We also received cash from the 2 grants in the period. As we saw on the cash slide, 1.9 million pounds was received in grants and 2.5 million pounds was spent on fixed assets. Interest of 5.1 million pounds mainly relates to the RCF, leases and coupon on the bond. Debt issue costs includes the release of 2.9 million pounds to the P&L and 1.9 million pounds of costs incurred relating to the new RCF. Including other movements of 4.6 million pounds, the net debt, excluding the impact of discontinued operations, is 216.7 million pounds, and overall closing net debt at 31st of August 2021 is 230 million pounds. Let me hand you back to our Executive Chairman David to talk to you in more detail about our operating divisions. Thank you.
Thanks, Lewis. We will now discuss each division's performance. Starting with our renewable energy business, Stobart Energy. As expected, Stobart Energy saw a marked performance improvement on the back of increases in waste wood supply, gate feed pricing, and plant availability. It supplied 706,000 tonnes of biomass fuel to energy plant customers during the period, representing a 14.5% increase in volumes. In turn, revenue was up 14.8% to 38.1 million, and EBITDA was up 279.1% to 9.1 million. The more stable market conditions means we now have confidence in setting market guidance. We anticipate that Stobart Energy will achieve EBITDA in the range of 18 to 20 million pounds after group recharges, based on the expectation it will maintain a supply run rate of 1.5 million tonnes, normalise winter gate fees, and that the plants we supply do not experience any unplanned outages. ESKEN further anticipates that Stobart Energy is well placed to build on that FY22 outlook as it continues to improve profitability. Turning to slide 17, we provide more detail on the improvement in gate fees. There are 2 key drivers at work. The first is that you typically see more construction work in the summer, which leads to an increase in waste wood availability, and that increased supply will lead to an actual increase in gate fee pricing. The second driver reflects the actions we took in the prior period. By taking the active decision to increase our stock levels at the end of last year, and by using our significant storage to ensure we had sufficient waste wood, we were able to manage gate fee levels and avoid having to chase supply. Gate fees generally soften from their current levels in the second half, but we expect to see an increase in volumes supplied. It might be helpful to provide some further detail regarding supply and demand. We have a market-leading procurement team who utilize our contact base built up over the last 15 years to source processed waste wood from third parties. We typically procure wood in the north where gate fees are weaker, or in areas such as Wales where we don't have our own processing facilities. We also receive unprocessed waste wood for which we charge a gate fee that is below the cost of sending it to landfill, which would result in harmful methane gases being released into the atmosphere. There is a very clear environmental focus on this now. We largely focus our unprocessed waste wood operations in the southeast, where gate fee pricing tends to be higher. We process the waste wood to meet customer specifications ahead of supplying it to the biomass plant. We supply 1.2 million tonnes of processed waste wood under long-term exclusive supply RPI-linked contracts to biomass plants across the UK. Stobart Energy also supplies 500,000 tonnes of virgin wood. This wood is largely sourced via managed sustainable woodlands. This essentially means work to thin woodlands to allow more light in and enable it to become healthier. It also includes gathering branches and other byproducts from trees planned for felling. This material is fed into plants designed with a virgin wood burning requirement, and it is typically required as part of a blend with lower quality waste woods. On slide 19, we set out the key elements of our established supply chain infrastructure. We maintain a market-leading position for procuring waste wood. Each week, we transport nearly 30,000 tonnes of fuel around the UK and have relationships with over 350 suppliers, from local skip companies through to Tier 1 waste companies. We have invested in and established 6 strategically located processing and storage sites, one with its own port facility, 2 other port operations, and a drying facility. These provide strategically placed storage, enabling us to manage the seasonal as well as geographical supply and demand challenges of the UK waste wood market. We've invested over 25 million in fixed and mobile processing equipment, and we work closely with processing manufacturers and invest in the latest proven technology so that we can provide finished goods to the highest standard of the quantities required. Our fleet of 145 specialist walking floor trailers, strategically located at 11 depots across the UK, are specifically designed for transporting waste wood, virgin wood, and recycled fibre. Let me now move on to our aviation division. The challenges brought about by COVID-19 and the resulting impact on travel led to passenger numbers declining 63.2% to 46,000. In order to manage the impact of this, LSA made use of the government's furlough scheme and maintained tight cost control. The airport continues to benefit from global logistics income through the winter period. That operation has been disrupted to some extent by volatility in consumer demand and by Brexit and its impact on border controls, which has led to fluctuations in the number of aircraft turns. However, flight volumes are expected to maintain a generally positive trend over the medium term as matters begin to normalise. The combination of reduced passenger numbers, partly offset by global logistics income and tight cost management, meant that the airport made an EBITDA loss. However, the division as a whole made a 762,000 EBITDA profit, up 181.4% on the same period last year. This performance was helped by contributions from the airport's hotel, the solar farm, and Stobart Aviation Services. The main contributor was a one-off receipt of £3.5 million associated with Connect Airways and the conclusion of the partnership with Teesside International Airport. The key focus for LSA is to secure new commercial passenger agreements with airlines where the economics recognise the compelling offering of LSA. The team are in constant dialogue with a range of airlines, offering a clear proposition of proven routes, peak slots, cost-effective operations, and an attractive and growing catchment area. The expected return of passenger demand in April 22, when summer flying begins, and the announced increases in aircraft fleets over the next few years, gives a positive backdrop to these discussions. I will provide more information on that clear proposition over the next few slides. LSA has a catchment area of 8.5 million residents. Importantly, there are 26 million passenger journeys taking place within our catchment area. 70% of those journeys are taken by residents living within a 60-minute journey time from the airport, the remaining 30% coming from people travelling in to our catchment area from abroad. For the majority of major Essex population areas, including Chelmsford and Colchester, it is easier to get to LSA by train than it is to get to Stansted. The airport is also well served by road routes. But of course, the major opportunity arises from our proximity to London. LSA is served by direct trains from Liverpool Street in 51 minutes and Stratford in 42 minutes. These stations are surrounded by East London boroughs with fast-growing populations. Barking and Newham are areas expected to grow in population by 14% and 18% respectively in the 10 years through to 2026. Both are best served by direct trains from Stratford. Our access to growing London populations will be enhanced even further with the opening of Crossrail connecting to both Stratford and Shenfield. We believe passengers are increasingly looking for a quick and easy passenger experience. On the graphic on the right of the slide, we have shown the average journey times from the City of London to the gate at various London airports. You can see our train journey time is fairly similar to Stansted, but the walking distance from the train station to the gate is considerably quicker at LSA. It's the same story at Heathrow, Gatwick, Luton, and increasingly London City. Maintaining our quick and easy airport experience as passenger numbers grow will be a key focus, and we have significant opportunities to maintain passenger flow and experience while passenger numbers start to improve. LSA has been in a position of limited airline agreements and passenger numbers before. The big difference between then and now is the data behind 40 routes previously flown by Ryanair, Wizz, EasyJet, and KLM. LSA can demonstrate the types of load factor, catchment interest, and route development that an airline should expect, providing greater confidence when the airlines assess fleet deployment. There are a number of routes that should prove popular for airlines, including hub destinations such as Amsterdam and Dublin, and summer sun destinations, including Alicante, Faro, Palma, and Malaga. Airlines across the market are currently holding back and committing to fleet deployment and putting flights on sale for summer 22. We expect that to change following the aviation conferences, including the World Routes Conference in October 21, where LSA had a strong presence. We remain confident in LSA's passenger proposition and the ongoing discussions with airlines leading to a pickup in passenger numbers for summer 22. In conclusion, after several years in which the board and management have been required to focus on and resolve legacy challenges, ESKEN is now well positioned for growth. Our renewable energy business has had a strong start to the year, and we are confident in our expectation that the business should deliver 18 to 20 million EBITDA after group recharges for the full year. While a recovery at LSA will take more time, we are confident in our commercial passenger offering, and it will benefit both from our logistics operation and our partnership with Carlyle. The long-term attractions of LSA to both passengers and airlines remain compelling. We will continue to look for efficiencies and maintain tight cost control as the businesses recover and grow. And importantly, we can now get on with the business of delivering that growth, thanks to the solid financial foundation supported by shareholders and our strategic development partner as we move beyond the pandemic. Thank you very much, and now we'll take questions.
That's great, Lewis. Charlie, thank you very much indeed for updating investors today. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the company take a few moments to review your questions submitted today, I'd like to remind you that the recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet Company dashboard, and we'll send you an email when that's ready for your review. I'd also like to remind you that your feedback is important to the company, and immediately after this presentation has ended, we'll redirect you for the opportunity to provide your feedback in order that the company can really better understand your views and expectations. Lewis, David, obviously investors have submitted questions. Hopefully you can access those on the right-hand side of your screen. If I could hand back to you, if I could ask you to read out the questions, perhaps even who it's from, and give a response where it's appropriate to do so, and I'll pick up from you at the end.
Thank you very much. Good morning, everyone. I will take the first question. We got a question from Gerald, who's asking, what is the difference between the new management board arrangements and a conventional CEO? I mean, effectively, what we've done is we've split the role that a CEO would typically do. So I will be covering stakeholder management, strategy execution, and executive leadership. And then Lewis and Nick will be dealing with the clear operating focus on the business and driving the delivery of a performance in these. So effectively, it removes one role from the structure, which has a cost saving, makes it a flatter structure, makes it more effective with fewer lines to go through to get to the top of the company.
Okay. Let me take the next one, which is Stuart R. Do you foresee any of the main passenger carrying airlines such as Ryanair, EasyJet, or Wizz Air using Southend coming back? Do you intend to enlarge cargo carrying airlines? I think essentially, as we said in the presentation, we remain confident on our ongoing discussions with airlines for summer 2022. And we believe that airlines will want to benefit from what we offer, which is a cost-efficient and easy passenger experience as well, with proven routes out of the London market. We don't declare the airlines that we are talking to, but clearly we are talking to the main airlines within Europe that you would expect us to be talking to, and we continue those discussions. And when we're able to make an announcement, we will be pleased to make an announcement once we know what summer 22 schedules are looking like.
Thanks, Lewis. There's one from Rob here. You mentioned cost headwinds in energy, drivers and fuel. How do you offset these cost pressures? And can you also update the development of handling other types of waste energy, for example, household refuge? I mean, in terms of the cost pressures, we've taken account of that in our guidance, which we're giving. It comes down to managing the gate fees and managing the stock levels from these businesses. And we've taken account of that, as I say, in our guidance for the full year. As regards handling other types of waste, we very much see FY22 as a year in which we focus on getting the business performance absolutely right with what we're doing. And then we'll start looking at other elements of that in future years.
To the next one, which is from Rob B. Thames Freeport. Can you discuss any benefit you may see at LSA from this initiative? We essentially have seen a grant come through on that, and we are currently investing in the north side of the airport where our current global logistics operation is to enhance that area more. So we are seeing benefits there coming through.
And then we've got probably you from
okay. Alex L, could you please elaborate further on upcoming aviation conferences and your comment that airlines are holding back at the moment? So we had the Roots conference was in Milan a couple of weeks ago. That was attended by London Southend Airport's team. And there is also the slots meeting next week. So we are continuing the dialogues through those conferences within that. And obviously the holding back statement is with regard to the fact that normally by now you would see the summer schedule. And that's not what we're seeing from the airlines at the moment. So that's that.
And the next one again from Alex. Your 22 energy guidance is working off 1.5 million tons of feedstock. Am I right in thinking that absolute capacity is closer to 2 million? And if so, what, in your view, are the constraints and timelines for increasing throughput? You're right in terms of capacity, it is closer to 2 million. This was why at the time of the in the finance raising, we indicated that we would look to augment the business with potential supply contracts elsewhere, and we would have the capacity to do that.
And Stuart R, my apologies, you are quite right. I didn't address you enlarging cargo capacity for airlines at LSE. I think that we have thought processes around the cargo business, and obviously we do look at what the opportunities are there and whether there are other cargo carriers that we can use. There are constraints with cargo with regards to night slots, so we have to be sensible about that. But it is something that we continue to look at.
That probably links into Damien's question.
Yeah, I think Damien B, can you expand further on LSA logistics cargo performance? How much headroom is there for cargo flight expansion as Heathrow slots refilled with passenger airlines? So we do have a constraint with regards to cargo, which we've explained before, which is a percentage of the overall flights that we can do. So we can't grow cargo in excess of passenger setup. So we are careful about what we can do with cargo. And what we've seen currently, and as we said in the RNS, we have seen that there has been a reduction in the activity of the logistics side, and that is direct as a result of Brexit and the border controls that are there. But in the medium term, we do expect to see that recover and come through. So that's our expectation for cargo.
And I think the next one on tax credit.
Okay, that's me as well. So Damien B again, please can you explain more about the £9 million tax credit, whether there are other provided for or written down items where there might be a chance of future revisions. This is very specific. So you may remember when we did the prospectus, there was 16.1 million of legacy tax cases that we were providing for. We've actually changed our tax advisors to PwC tail end of last year, and we've been doing a significant amount of work with them with regards to these cases, and have been heavily engaged with HMRC with regards to that. So that's why you're seeing a revision in our position around those tax cases. I think other future revisions, I think that's probably about the right level for tax while we go through it. And on other revisions, I don't think there's anything else that I would comment on at the moment.
And Alex has come back to say, just coming back on energy capacity, what would drive getting towards 2 million? How much of that is under your control? I mean, effectively, Alex, we have the infrastructure to facilitate getting us up to 2 million. As with any market conditions will drive that. There are opportunities out there. We're constantly looking at them. There are places we can supply on a non-exclusive basis from our existing operations. So it's very much a case of either on an ad hoc basis or whether on a contracted basis being in a position to do that. At the end of the day, if we've got the material people want, and we're one of the biggest players in the market, we do have a real opportunity to do that over the medium term.
David Lewis, I think you've pretty much taken all the questions that I can see on the panel that have been submitted by investors. So thank you to investors for submitting those questions. I guess as I speak, more will come through. In the event that no other questions do come through, David Lewis, perhaps I could ask you for a few closing comments. I know investor feedback is important. We'll shortly redirect investors to give you their thoughts and expectations. And as I say, Ross H has just I think a question may have just come through. So if I just hand back to you, if there are any further questions that you can address, please do so. And if not, if you could follow up with a few closing comments, and then I'll redirect investors to give you their thoughts and expectations.
Thank you very much. The question has just come through from Ross H. Firstly, can you update on the expected sales timeline for non-core assets? Is any monetization likely and have to? I'll maybe ask Lewis to touch on that.
Okay, so we continue to actively work on those disposals, and as we are able to announce, we will announce any movements on that. But we are definitely in line with expectations around it.
Yeah. And the second part of Ross's question was approximately how much waste wood are you currently storing, and do you see any supply pressures and have to? I think as of now we're probably around 80 to 85,000 tons of waste wood. We are content with that level to meet our obligations through the winter period. So I'll just pause just for a minute in case anyone else has got any further questions or any follow-on questions, and I'll maybe just make a few closing remarks. I think, I think there's a question about customer appetite to use the airport passenger traffic, constrained by airlines. I mean, I think Lewis has probably effectively covered that already. Our focus has always been, from the time we did our investor presentation, as to expecting very limited winter flying and the focus on summer flying for summer season 22, which starts in April 22, and the clocks change. And we'll update you as soon as we get anything to say on that. Looks as if there are no other questions. So listen, thank you very much for joining us this morning. It seems we've had quite a regular dialogue over recent months. It's quite nice to be in a bit of a steady state. I mean, effectively, sort of key takeaways: energy business strong performance in the first half. It has returned to pre-COVID levels, and we're now issuing our guidance in that business for the full year. Aviation is effectively where we expected it to be. There is a lot of dialogue going on with airlines. The general trend is positive in the marketplace for flying next year. I think, as I said before, at the end of the day, the great British public like their holidays in the sun. So as restrictions continue to be eased and we get through the winter, we would fully expect to see more flying taking place next year. I think finally, having had the success of the capital raise and getting the balance sheet right and giving us the position to move forward, we've now got a refined management structure which allows us actually to focus on the performance of the business looking ahead. And we very much look forward to engaging with you in 6 months' time when we're back with our full year numbers.
That's great. Lewis, David, thank you very much indeed for updating investors this morning. Could I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that the company can better understand your views and expectations. This will only take a few moments to complete, and I'm sure is greatly valued by the company. On behalf of the management team of ESKEN Group, I'd like to thank you very much indeed for attending today's presentation. That now concludes today's session, and good morning to you all. Thank you once again.